And let me throw up my deck on the
Awesome.
screen.
Yeah. And I'll do a
Awesome.
little intro here. I'm so excited to dive into this event today. We're going to talk all about investing with confidence as an entrepreneur with Shang Saavedra. So for many, investing feels like it's outside of their scope of expertise, and this workshop is all about demonstrating that you don't need a finance degree to invest and yield profits. Shang is the founder and CEO of Save My Sense, a personal finance education platform that helps Americans learn how to grow their financial wealth by addressing their mental health. She finished saving for her retirement by the age of 31 and is America's leading expert on the key habits and behaviors that are needed to become less fearful of money and live a wealthy life with joy. Her insights have been published by Business Insider, CNBC, Forbes, Fox Business, USA Today, and more. She received her bachelor's degree in economics from Harvard and her MBA from the University of Chicago Booth School of Business. Her forthcoming book on personal finance will be out in early 2025, celebrating that. We're so excited to learn from you today, Shang. We know how valuable your time is, and we're just incredibly grateful to you for investing in Dreamers and Doers in this way. With that, I will hand it over to you. Thank you.
Thank you, Nicole. And I've been with Dreamers and Doers since 2017. Came in and out of Dreamers and Doers because Daryl went back to corporate for a few years. But always so happy to see you guys. And this page is just telling you not to sue me. The information that I'm providing is not investing advice, educational only. A little bit about my background. So I've been investing for more than 20 years. So sometimes people feel a little bit intimidated when they see my material. They're like, wow, Shang, you're going through so much information in such a short amount of time. But also keep in mind, I've been doing this for decades. And most of you are already doing something in your area with expertise for decades. So whatever you are good at, you also look very, very impressive to me. So just keep that in mind and don't compare. My first IRA, I started in college, and I'll go over what an IRA is. For most of my life, I worked in management consulting, primarily with private equity companies. And so those were the deals that I worked on. The worst investment I ever put my money into is whole life insurance. Happy to talk about that later. And I have familiarity with all of the following platforms. So if people have platform specific questions, I can also talk about the technology on all of these companies. Today, we're going to go over these topics. So let's dive in right away into my journey to FIRE, which is called Financial Independence, Retire Early. So this time frame is essentially from ages 22 to 31. I'm 39 right now, so it's been 8 years since this time frame. I was coming right out of college, working in management consulting at that time. Now it's even more, but at that time, before inflation, was a 5-figure starting salary and thousands of dollars in bonuses. And because I had no school debt, thank you, mom and dad, and scholarships, really appreciate it. I was able to save 30% of my pre-tax money. The gross savings rate just means you take the pre-tax income, you multiply by the savings rate. And then I had business school, also scholarships, and parents helped me out. So no debt there. Definitely won the lottery again. And then coming out of business school, my starting salary were in the 6 figures and my bonuses were in the 5 figures. And married my husband, we lived in Manhattan, New York, and we pushed our saving rate up to a 40 to 50%. We don't save like that anymore because we got 2 kids and 2 cats and they eat us out of house and home. But again, just keep in mind that this is what happens when you are double income, no kids. In the meantime, I always love to punish myself and take on 2 jobs. And then so I was not only in management consulting, I also was a wedding photographer. And from that wedding photography business, I did not spend a single dime. Every profitable dollar I had, I invested it into the stock market, and I counted all in about $200,000 of investments from that as well. So I do want to say my life story is not what I expect most people to replicate. It is very rapid. There's luck involved, privilege for sure. And I also work like a dog. I do not want to work like that anymore. For most people, I expect that most of you are looking forward to retirement in your late 50s, early 60s, and you do not have to go at this pace. Absolutely not. This is not the expectation. And so let's dive right into what is an index fund. I'm here to break down investing into concepts that are as common as high school English. That's really what I'm here to do. If at any point you find what I'm saying is confusing, drop your question in the chat. I can answer it as I present, and I'm also happy to answer during Q&A. I've reserved about half of today's time for a Q&A, and I love it when I have an intimate audience because that means I can really, really dive deep into your individual questions. So most of you guys are entrepreneurs, so you know that you are an owner of a company at this point. And should you decide to take your company public on the stock market, you're selling ownership in your company to other people. So other people, when they buy a stock, not debt, because some people finance via debt, like you take on loans. Some people finance by going public. When you go public, the people who buy stock in your company, they own a right to your company's profits. So the profits that you make each year, you can choose to pay out to your shareholders in terms of dividends. And at the same time, if your company is projected to do well because of things you've announced, new products you're making, new clients you've taken on, revenue streams, expansion, yada, 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 the stock price of your stock could increase as well. So let's just make a very easy visual example. Let's say your company is worth $1 billion. We're all here to build $1 billion companies. Let's aim high. And you have 1 million stock shares. And actually, the number of shares for a company is very arbitrary. The companies themselves kind of decide on this. So the price of one share is your company worth divided by the total number of shares. Again, this is very simplified. So if you're a $1 billion company with 1 million shares, each share is worth $1,000. And let's say, just to confuse you a little bit more, you made a profit of $1 million each year, and you want to pay that profit out to all of your shareholders. You divide $1 million divided by your 1 million shares. So each shareholder gets $1 in dividends per share that they own. This is a very simplified version of how stocks work, but the better way to think about the stock market is that most people think the stock market is made up of people running around on Wall Street shouting at each other and secret tapes fall and then somebody bangs the bell at the end of the day. Whereas for me, when I think about the stock market, it's really made up of thousands of real companies. And the top companies that are currently traded on the United States stock market are very, very recognizable. If you guys just take a look at all of these logos, you probably know at least half of these, if not all of these. And that's what we're doing when we decide to invest in companies, is that you're buying into these very, very well-known companies. Then why is it that we see in the news all the time, stock goes up, stock goes down? How does that work? Well, so there's two pieces to a stock. There's the dividends that get paid out, but then there's also the price of that stock, which is determined by how much people think a company is worth. And if the company announces good news, announces expansion, growth, then the company's worth more because the likelihood of that company doing well over time rises. And then so the stock price goes up. But if the company does poorly, they lose their CFO, or they get a huge lawsuit and it's going to cost them, half of their revenue, then people are like, oh gosh, this is not a great company to invest in. I'm going to get out. And they start selling the stock and that price goes down. This happens all the time because companies operate every day, and every day a new surprise happens, as we all know as entrepreneurs, and the business news reports on this. And the business news loves reporting on the drama of the stock market because that's what gets people to read the news, and that's how media works. People want to read viral stories and things like that. And oftentimes when I'm teaching beginners investing, I tell people kind of ignore the noise, because there's always going to be a lot of noise and a lot of volatility in the stock market. But if you're not looking to get your investments out for years and years, you don't have to listen to the noise at all, unless you love reading about drama in the stock market. Then, read it for dramatical purposes. So what is an index? Well, an index allows us to track what happens over time with a lot of companies. Because if you try to read the news for hundreds or thousands of companies, that's really painful. But you want to say, how does the entire economy look like? Well, an index takes the average of the stock price movements of all the companies that are included in an index and then averages it out. So the most well-known index of all is the S&P 500. It takes the 500 largest companies that are traded in the United States stock market at any time and averages out the movements. And that shows how the US stock market does. And this is just a screenshot from Google Finance. It's a little bit old, but it shows how the index was up and down. And typically when you see the decreases in the index, it usually correlates with a recession as well. So for many people, they don't want to buy individual 500 stocks at a time. Just imagine having to do 500 stock transactions on a investing account, painful. So why not just do one purchase and that does it all for you? So an index fund allows you in one transaction to buy all the funds inside the index. So there are many indices around the world because it's not just the US. We have an index for Europe, an index for Asia Pac, index for Middle East, index for developing countries, things like that. But if you want to buy the 500 largest companies in the US, you could buy an S&P 500 index fund. This is just a snapshot of one offered by Fidelity. Many financial institutions offer these types of funds, and they'll all put their own brand name in front of it. So there could be like the Fidelity Index Fund, the Schwab Index Fund, the Vanguard Index Fund. If they all do S&P 500, they literally all do the same thing. So you're buying the same plastic cup from Walmart versus Target versus Albertsons, kind of like that. So that is an index fund. And people talk about index funds all of the time, and I'm going to show you why. It's because index funds are super easy to invest in, and they've shown the ability to generate wealth and returns. And here's why. On the left-hand side, this is a chart of a dollar, the buying power of that dollar over 30 years of time. And on the right-hand side, we have the investing power of that dollar over time, same time frame. Basically, if you leave your money in the bank, yeah, you get a little bit of interest on it, but over time, $1 today is not going to buy the same amount of stuff as $1 tomorrow. I'm still shook today, guys, of how much it costs for me to go to the movies. I still think about when I was a kid that it cost me $5 to go to the movies, and popcorn did not cost $15 a bucket. That is just, it is robbery. So I am that person who sneaks a candy bar in her purse to go to the movies. Shame on me. On the right-hand side, but if you were to invest and accounting for inflation, actually, $1 in 1990 would now be worth more than 10 times today, which is fantastic. So let's put it into more real numbers. These are the annual returns of an investment, no dividends, because dividends make the math a little bit harder. But if you were to start in the January of that year, all the way up to this year. So the way to read this table is if you began investing in 2003, on average, how much would your investment have returned year by year from 2003 to today? And then in this table is if you began in 2012, on average, your investment would have returned 11.4% up to today. So these are really great growth rates. 2023, we had a big AI rally. That's basically what happened in 2023. Whereas 2022, because of the high inflation, the Fed raising interest rates, all of that, that was a pretty low year. Because of the things that happened during that time. What's also counterintuitive is that people are like, Shang, where's the Great Recession and all of this? Well, it's been a while since the Great Recession. The Great Recession was 2008 and 2009, but because it was so long ago, markets rebound, companies are resilient, people who are entrepreneurs recover in the face of adversity. And since it's been more than 10 years since the Great Recession, if you held your investments during that time, at that time, it sucked, but now you would also see growth on your investments. And in fact, you would see above average growth because you're buying at the bottom. So the growth is a little bit faster than some of the other years. Then let's put this into actual numbers. If you made a one-time $10,000 investment at the start of each of these years, so the longest investment period is the oldest year. So in 2003, if you made one time a $10,000 investment, you just held it for 20 years. And this table is updated as of April 2024. Then that $10,000 would have multiplied by 5 to today. You would have about $52,000. The numbers tend to get a little bit smaller as we get closer and closer to this year because the holding period, the time for which you're investment could compound is less. And so by the law of compounding, you typically have less money the more recent your investment was. The longer you invest, the more money you have. And this is the more powerful illustration that I wanted to show. What would happen if you invested versus putting money into like a 1% a year interest-bearing bank account? So this chart, I know there's a lot of numbers. This is the most numbers I have in this presentation, by the way, is if you were to invest $10,000 each year between 2023 up to today, this is the return. Just keep in mind the return rates from a couple of slides ago. The middle slide shows how much money you would have if you just saved it with a 1% interest-bearing account. And this part shows how much you would receive as an investor. And this is the most powerful. Again, the longer you're holding the period, the more money you have. So somebody who has been consistently putting in $10,000 each year, over 20 years, that's $200,000. But that $200,000 grew to more than $500,000 today. So that's the power of compounding interest and the power of consistency over time in the market. For people who may have started 2 years ago, okay, $20,000 grew to $21,000. It doesn't feel like much, and I agree. When you're a beginner investor and you're only looking at 1, 2, 3 years out, not a lot of growth. It's not going to feel like a lot, but the key to investing is to have the patience and to be like, I believe that these things work and that they will grow money. And over time, in the blink of an eye, 20 years has passed. 20 years, 2003 was when I entered college and I began my IRA. So yeah, that is the power of investing. And that's what I wanted to show. And so immediately people are like, well, how do I do this? And what are the mechanics for doing this? What buttons do I click? So specifically for entrepreneurs, I wanted to highlight a few accounts that you can take advantage of. First, let's look at just what the heck all these terminology means, because it can get really confusing, especially in the United States. So we've been talking this entire time about the first two boxes, the stock, which is sitting inside an index fund or a mutual fund or an ETF. An ETF is an exchange traded fund. It acts very similar to a mutual fund. They're practically the same thing. So those are all investments. Then you have to buy these investments in some form of an account. And that account could be a 401k, an IRA, or taxable brokerage, which I'll explain on the next page what the heck all those words mean. And those accounts can then have different tax statuses. A tax status just refers to how is this money that's in the account going to be taxed when you withdraw from it. A traditional or tax-deferred tax status means you're going to be taxed when you withdraw, but you didn't pay taxes going in. The Roth is the opposite. You pay taxes on the money going in, no taxes when you withdraw. And taxable is taxed both ways. You were taxed going in, and you're also getting taxed on the way out. And then finally, the biggest wrapper that encompasses all of this is the financial institution, which to me, like, there's not that much difference between an Albertsons and a Safeway. Well, they're the same company. So that's what I mean. It's like different brands, but same services. So Fidelity, Vanguard, TIAA, which is very popular among nonprofits and teachers, Charles Schwab, which recently merged with TD Ameritrade, are some of the largest financial institutions or brokerages in the US that you can use to establish accounts and invest. There are three main kind of buckets of investing accounts that you could use for retirement. Specifically for entrepreneurs, the first bucket is actually the solo 401k or the SEP IRA. These are designed specifically for self-employed entrepreneurs and typically solo entrepreneurs with no full-time employees. If you have full-time employees, then you're likely either doing a SEP IRA or you've set up a small business 401k with a small business 401k provider. The next bucket is an IRA, which is something that you open yourself. And then the last bucket is a taxable brokerage, which you also open yourself. The first two types provide tax breaks. Given the amount of time that I have for today, I'm not going to dive deep into the tax breaks, but basically you want to use the first two before you go to the latter. There are limits on how much you can put into these accounts, and I'll explain the solo and the SEP on the next page. there's a catch-up contribution. Basically, people recognize that people sometimes take too long to save for retirement. So if you're age 50 and over, you have a little bit extra that you can put into these accounts. And then because these accounts are designed for retirement, there is a 10% penalty if you try to withdraw from them before age 59 and a half, but there are some exceptions to the rule, and the taxable brokerage is a very unlimited, very flexible account that you can withdraw from at any time. So the solo 401k works in the way that you put in $23,000 from your employee side, and then as an employer, you can put in another 25% profit share, 25% of your profits. The sum of these two is not to exceed $69,000. The SEP IRA, bit similar, but basically you can put in 25% of your profits up to $69,000. The solo 401k has the additional benefit of the catch-up contribution. If you're age 50 and over, you can put in another $7,500. The SEP IRA does not have that. Both of these accounts have penalties before age 59 and a half. If you're like me, at one point, I worked as a W-2 and as a solopreneur. If you are doing that, you cannot double dip across two 401ks. And so if your W-2 job gives you a 401k and you as a solopreneur also have a solo 401k, the $23,000 limit is across both of them together. Whereas a SEP IRA, it's different. You can do your W-2 401k, and then you can also do the 25% in the SEP IRA. If you have a spouse and the spouse goes married filing joint with you in taxes, the solo 401k actually allows your spouse to also participate in the solo 401k. SEP IRA does not do that. Both of these accounts have what's called required minimum distributions. Most of us don't need to worry about this until we're age 75. Around age 75 is when they force you to withdraw money from the account so they can be taxed. And so just to give an example, if your business made 200 in revenue, your costs were 100, you have 100K in profits, for your solo 401k, you can put in 23,000 plus another 25,000 in profit. So that's $48,000 maximum contribution. And that then gets deducted from your profits. So your taxable income goes down to 52K. Awesome. Save taxes. We all love that. SEP IRA, very similar. If I made 200 and I had 100 in business costs, so I have 100 in profits, I put in $25,000 into my SEP IRA. And then to lower my taxable income, I now have 200 minus 100 is 100 in profits, minus my 25K contribution, my taxable income now is $75,000. So we all love to pay a little bit less in taxes and keep a little bit more money. And finally, why I believe that all of us can do this without hiring a financial advisor. And this is because I've been coaching hundreds and hundreds of families for so many years. Whenever I see people use a financial advisor, the one thing I notice is they're overpaying for advice that is very, very generic. So here's the truth about human advisors. Most of them, the human advisors, so these are actual like people that you can call up and stuff, they charge a 1% annual fee off of everything that they manage for you, regardless of performance. So let's say your investments grew 10% in a year. If they charge a 1% fee, your actual return is 9%. Because they take that 1% fee off the top. And let's say your investments lost money in a year, you're going to lose additional money because they're going to take 1%, even though you lost money. And the main objective for many of these human advisors is because they make money off of this kind of like, not profit share, but like percent of assets management fee, then the more money they make, the best way to do this is to go after high earning potential people. And I've seen a lot of financial advisors prey on entrepreneurs, on people who look like they're making a lot of money from their businesses because they're like, oh, that person must make like, $500,000 and 1% off of that is, gosh, my math is not fast enough, $5,000. So that's easy money for them. Not 5,000. And they're not even necessarily investors by training. When financial advisors from companies like Edward Jones, Raymond James, Ameriprise work with you, they're using basically software provided to them by their companies, and they plug in your age, your preferences, and it spits out a bunch of investments that they invest you in. But the person that you're working with is probably not the actual investor in the company, the person who's been trained through Series 7, etc., to set these investments. And furthermore, this is the shady truth about human advisors, is that many of them sell you life insurance. Why? About half of that first year's premium that you pay towards life insurance becomes the commission to the human advisor. I was sold a whole life insurance policy that cost $8,000 a year, which meant that my human advisor made $4,000 by selling me that product. And they're not really focused on tax efficiency. If you find any human advisor telling you to avoid a solo 401k or avoid a SEP IRA, I would run the other way, because they probably don't know what the heck they're talking about, because entrepreneurs want to save on taxes, and the solo 401k and SEP IRA do exactly just that. Now, a little bit more data. In 2008, Warren Buffett bet a hedge fund manager $1 million of his own money that index stocks would outperform hedge funds in just 10 years. And hedge funds, as many of us know, are professional investing firms with like PhDs and people who are like supposed to be the best at investing with 20% carry fees. So the hedge fund manager picked like 4 or 5 of his favorite hedge funds, and they're waiting 10 years. Well, not even 10 years into the bet. At 2015, he already admitted defeat. He's like, okay, yeah, you won, Warren Buffett. The index stocks outperformed. And the actual data sits on the right-hand side. The SPIVA scorecard is something that you can Google very easily. SPIVA is the company behind S&P 500, and they track the performance of funds against indices, because S&P created an index. And they found in the last 15 years that almost 90% of all actively managed stock funds in the US underperformed the S&P 500. That's a failure in my Asian mommy eyes. Like, terrible. So these 2 pieces of anecdotal advice, but really grounded in data, should show you that if you just decide to do index funds, you're fine. Like, being average is totally fine. Like, there's nothing wrong with doing that. And if you're still not comfortable doing any of these, this is the hack that I teach all of my students, which is you can open a robo-advising account. Robo-advisors are digitally native platforms that use software to invest on your behalf. So instead of dealing with a human, you tell it the software, your age, your goals, your risk tolerance, when you want your money, and then boop, 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 they will come up with a portfolio for you. And most accounts are free to open. And this is my hack. Don't put all your money with the robo-advisors either, because over a certain amount of investments, they also start charging fees. Their fees are usually half of a human advisor, so around 0.2 to 0.4% is what I've seen. But instead, this is my hack. Put in just a little bit of money, like $100, and let them pick a portfolio for you, and then copy that to the rest of your non-advised portfolio. So you literally have the advice, but you copy it over. Kind of like how a stylist at Nordstrom can give you some outfits, but then you're going to take pictures of that, and then you're going to go shop on your own at like TJ Maxx or something. So this is my hack, which is you pay a little bit for advice, but then you do some of it on your own, and actually have several students who are actively doing that and learning how to do that, and they save a ton of money that way. And also, you don't need a lot of time. We're all super busy, so I'm super, super psyched that you guys are even on this call, because I know it takes a lot out of your day to give up 1 hour to listen to this crazy lady talk about investing. So let's talk about it. If you were to work a normal corporate full-time job, but I think most of us work double that amount, you work about 2,000 hours a year. It takes 5 minutes to open an account. It takes 5 minutes a year to set up your 401k contribution. And Nicole is graciously letting me talk a little bit about my class. I teach this more fully in a 2 to 3 hour class called the Save My Retirement Masterclass, which basically allows you to learn from me, which is somebody who's invested for over 20 years. And I teach much more about the tax hacks, because I'm like, the wealthy people, like the really, really wealthy people, they don't often talk about money, and they might talk about how they make the money, but they really don't talk about how they save on taxes. And once you reach a certain threshold of wealth, it's not making money that's the hard part. It's avoiding overpaying, over-tipping the government. And so all of this, the stuff that I teach allows you to preserve 20 to 40% more of your savings each year. And that's significant. You could look at more than $100,000 of lifetime earnings. And so the masterclass is 2 to 3 hours of self-paced videos. So literally, I've recorded these videos. You can watch them on your own time. The first 60 days of when you get on the class, I will guide you through the videos because I'm like, okay, you can binge it like a Netflix show, or if you want to do 15 hours a week, 15, not hours, 15 minutes a week, I have an email that guides you through that. And you can email me back with questions on any of the content. Money back policy if you find out it's the wrong class for you. And I actually update the class each year because IRS changes all those numbers. So what's $23,000 today for that contribution limit could actually change in the next half year or so. And I do Zoom office hours kind of like this every 2 months, also recorded for those who cannot attend live. And these are all the topics that I teach. So what I showed you today was a bit of a preview of chapter 5 actually. So chapter 5B and 5C, I talked about the SEP IRA, and then I touched just a little tiny bit on IRAs in chapter 2D and taxable brokerage in chapter 2F, but this entire course covers way more than that. There's also stuff for parents if you're thinking about providing for your kids, advanced retirement if you want to access the money earlier, and then also resources like what books, what websites, what brokerages, which financial advisors to avoid, and which ones to actually use, robo-advisors, and then a strategy for putting together your retirement strategy for yourself. And you can use the QR code on this page and the coupon code DD sale to get it for $250. So that's the end of the prepared section of the class. I'd love to take questions, comments, anything that you guys want. And we can also go off topic too. If there's anything that you didn't see covered in today's class, but you have a burning question on it, I'm more than happy to help you out with that as well.
I have a quick question. Hi,
Mhm.
Shang.
Hi.
So it's more, I guess it's still in the investment realm, but rather than like the stock market, it's, it's housing.
Yeah.
And I know you do talk about it like in your channels. Of course I follow you, but and this one's might be personal because we moved back to the US and we're now in the like New York suburbs. The housing market is absolutely insane. And we're kind of at a place we're buying a rental. And I'm like, my husband is like the one who's like really keen to buy because he's like, we're going to be homeless. And I'm not, because I think this like current market is a complete bubble and we're definitely overpaying. But I also get it because we've got older kids. So like they're already in the school system and we're kind of trapped. How do you, I don't know, do you have any resources or recommendations in terms of like, handling, I guess,
Yeah.
like that?
Yeah, I could talk about it broadly, and then Liz,
Mhm.
because I have your email, I can also email you some blog posts after this class. A house is an asset, so I do want to acknowledge that when you put a down payment on the house, the amount of down payment that you put in, that part of the house is already yours, and then you live in it. And then there's two costs to the house. There's the mortgage, which essentially you're taking on a loan to pay yourself back the value of the house. And then there's the non-mortgage pieces, which are the homeowner's insurance, the property taxes, which if you're in a good school district are going to be high because the property taxes then fund the school essentially. And then all the upkeep, the utilities, homeowners, did I already say insurance? Lawn care. A lot of my clients are actually really getting bit by remodeling costs because your house, after several years, things are going to break. You're going to have to replace the heating, the ventilation, everything. And those costs always go up over time. So you kind of have to like forecast that out a little bit and compare it to what you would normally pay in rent. Because of all of those things, the only piece of money that's coming back to you is the paying down the balance of your mortgage.
Mhm.
Everything else is essentially rent, just the same as if you were renting a house. And if they're basically almost exactly the same, then there's actually not that much of an advantage in buying a house financially. And you have to really, really rely on the house's ability to appreciate in value and your ability to sell the house. And there's going to be closing costs and commissions off of that. So to give you a real example, this really differs geographically. I still own what I call a dead weight of a house in Manhattan. It's a co-op. I cannot rent it out after next year. And because there's just not a lot of demand for that kind of a house in New York right now, I'm selling essentially at the same price as I probably maybe would be able to sell at, gosh, I hope 150K more than what I bought it for. But I put in way more than 150K of costs into the house. Like I had a renovation that was $40,000 already. I paid 9 years of interest on a mortgage. Every year I pay $24,000 minimum in maintenance on the house for the doorman and etc. Obviously, that's more Manhattan than anything else. And then so if I look at it, that was actually my second worst investment. And so most people who make money from real estate, either they live in a really, really, really hot market, like California has always been pretty hot. So people in California are always making money with their houses, or you're renting out the home and you're actually realizing income from your assets. Because if you live in the home, you make no income. But the moment you rent out the home, you can deduct all of your costs against this income stream, pay very little in taxes, and realize possibly a profit. So I think you and your husband kind of just have to ask about, like, what's the goal of buying this house? Is the financial that you have to look at it as a financial calculation, or is it more emotional? A house can be a very emotional purchase. And I do say that there is also value, emotional value, in keeping your children in the same house for most of their childhood, not having to move around a lot. But if it's an emotional purchase, then recognize that there's just going to be costs going into it.
Oh, that's helpful. Thank you.
Yeah. I saw a question from Ashley. What do I think about a stock investing app like Public? I actually got to play with Public a little bit on my own. There's nothing really wrong with it. All of these apps just try to make investing a little bit more accessible, more fun, more interesting. As a long-term investor, I'm not the kind of person who's going to go on an app every day and check on my investments. I just think that's like way too much time of my own being wasted. But I don't see anything wrong with Public because I think you're still basically in control of your investments. You can pick whatever you want. I would just take a look at the fees and just make sure that they are reasonable fees, because again, we have these fantastic options like Fidelity and Schwab and Vanguard, where opening accounts is essentially free. I'm going to zoom out to a larger picture. I know got Ashley and Liz's questions. Sandra, Colette, or Catalina, any questions?
I do have a question. I love your, thank you very much. This is very helpful and you're very smart. So I appreciate that. I love your robo-advisor tip. That's very interesting to just see what they're doing and then do it on your own. My question is, where do you do it on your own?
Yeah. And I've got
platform?
I've got a slide to help you through that. So I have used many platforms. I don't know if you were here at the beginning, but I actually showed all of the different platforms that I had experience with. But my absolute favorite is Fidelity. I have my solo 401k with Fidelity. I have my IRAs Fidelity, and I have taxable brokerage with Fidelity. And the reason is Fidelity is very low cost. Basically, there is no fees to open an IRA or taxable brokerage with them. Furthermore, they have, I love this, they have US-based customer service. So like if I call into Fidelity, I'm not speaking to somebody in the Philippines who has no idea what a 401k is. That's really important to me. And Fidelity also has in-person offices in some of the larger cities. They actually have for me, Sandra, where are you based?
New York.
New York. Yeah, you'll find a Fidelity office easily in New York for sure. So let me just share my, actually I have a little walkthrough of how to open an account. So if you go to fidelity.com and you click open account, this orange button, it's going to show all of these different options. If you want to do a solo 401k, you actually have to find it on their website. It's not in the first menu. IRAs are the IRAs that I was talking about. So the rollover IRA is actually if you're moving a old 401k to a IRA. Then there's the Roth and there's the traditional. The taxable brokerage account, which is the one that's super flexible but has no tax benefits, that's a brokerage account. Spending and saving, this is literally just a cash account, like a high yield savings account. So don't open that one if you're trying to invest. Once you open it, they're going to ask for your personal information, all the information that banks typically ask for, yada, yada, yada. Then they're going to ask how you're going to fund your account. Typically, I start with a one-time transfer. So you do an electronic funds transfer, you type in your, okay, you select the Fidelity account you're transferring to, you link a bank, and then they're going to ask for your routing and account numbers. Once they've set that up, and Fidelity is pretty fast now, although just depending on your bank, some banks might be a little bit slow to respond. Once they're done, it will show that there's you can start moving money to the account. So you want to transfer money, and you say, I want it to transfer from to this Fidelity account, and then type how much you want to transfer, $250,000 limit. Then to invest, there's the trade button on the fidelity.com. You'll see the trade button, and using the Fidelity 500 index fund as an example, you select you want to trade mutual funds. There's other things you can trade: stocks, you can trade options, but to trade a mutual fund, you select mutual fund. In this case, I had a Roth IRA with $6,500 in it. I type in a symbol of what I want. Don't quote me a price because these things are traded during the day, so their prices move up and down. I say, all right, let's buy it. Put in $6,500 of that, click preview order, then click done. And literally this page takes seconds. And Sandra, if you want, I can email that to you afterwards, if I can find your name.
Yeah, thank you very much.
Okay, I will do that.
I have a question. Thank you so much for this, because I'm actually excited because I have not had a 401k or an IRA since I started my business. But this year I'm going to be able to start it. So I took a little break. I'm like, yay. But so I would love to know the difference between like a SEP IRA and a Roth IRA, because
Yes.
I want to ideally, well, not ideally, I know I'm coming into like a really big deal and I'm really excited because it's just a lot of money that I'm like, great, I get to like do different things now. Like have two accounts. And so how would you handle that, like in the SEP IRA and the Roth IRA? Like, could you do both? Is that something you advise?
Yes.
Okay.
Yeah. Let's revisit the screen. So even though SEP IRA has the word IRA in it, it's really confusing. It's actually less like an IRA and more like a 401k.
Gotcha.
So that's why they're actually separate. You can have a SEP IRA for your business, and you can also open a traditional or Roth IRA for yourself. The SEP IRA, you make a fund transfer, and then you report how much you put into it when you file the tax filings for your business. The traditional or Roth IRA, it's considered more of a personal transfer. So where you actually report this is on the personal side of your tax filing. So like the 1040 federal form, for example. You can have both. I typically recommend business owners to start with the solo/SEP because it removes taxable income from your business. And especially if you're looking at a large influx of revenue, it would be a really, really good year to do it to lower the taxes on your business income.
Okay, perfect. And is a solo 401k and a SEP IRA, are they different accounts or the
They
same?
are different. So the main differences between them is that solo 401ks almost kind of mimic like a S Corp structure. Are you S Corp or?
Yes, I'm an S Corp.
Yeah, so if you think about it, right, you pay yourself out payroll, and then you pay yourself in your distributions. Your $23,000 comes from your payroll. And then your business profit distributions, 25% of that can also go into the solo 401k. And both of these things lower your taxable income. Whereas on the SEP IRA side, it's just 25% of your compensation. I have had clients where they basically regardless of how we calculate this, it's over $69,000. So then that's great. They make bank. They can do $69,000 in 1 year. But if you're under that, the solo 401k is just a little bit more advantageous than the SEP IRA.
Okay. Yeah,
Yeah.
no, I'm definitely under that still.
Yeah.
Depending on how this goes, maybe I won't be. So like, but yeah, no, I think this is great. Thank you so much. And I know you already showed this, but I think all of this stuff is really confusing to me. So thank you for
Oh yeah. No, it's even teasing this apart on the IRS website. I had a lot of headaches creating this course for sure. It's like, why does the government make this so hard? So
because it's on purpose. They want to confuse you.
yeah.
Well, thank you. I really appreciate that. That really
Yeah.
helped.
And good luck.
Thanks. It's all working out, so I'm really excited about it.
Shang, I have a question for you.
Okay.
Do you have any thoughts on LVEST?
LVEST falls into the same category as robo-advisors like Wealthfront, Betterment, SoFi. They all pretty much do the same thing. I think LVEST does have a more of a angle towards targeting women and getting women to invest. So I like that about them. Their fees are practically the same, although I don't know if they have a subscription pricing as well on top. So you could use the same strategy, put in some money with LVEST, see what they recommend you invest in, and then copy it over to the rest of your accounts.
Love that. Thank you.
Yep. Cool. Yeah.
Any other questions before we wrap up? Okay, wonderful. And please, if you think of anything, feel free to drop it in the chat or just chime in. But I just want to say thank you to Shang for this wonderful, incredibly informative, very thorough presentation. It's so helpful, so fascinating. I know that it's so valuable to those who are here today, and also will be so valuable to those who are going to view this later down the line as an evergreen recording. So just thank you for your time and all of your wisdom and your willingness to share this information. It's just wonderful, and wonderful to have you as a member. And I also want to thank everybody who joined today for joining, and thank you for showing up and asking wonderful questions. I'm going to drop a little note into the chat, a feedback form, and then also a submission form for anybody who's interested in doing Dreamers and Doers events. And beyond that, it was just great to see all of you. Thank you again, Shang. Thank you all for showing up. Have a wonderful rest of your week. I'll see you all hopefully very soon.
Thank you, everybody. Really great seeing everybody as well.
Thank you.
Thank you. Have a good day.
Bye, everyone.